Client Briefing Webinars. Financing of Non-Performing Note Purchases with Brian Schaefer.
Hi, I'm Brian Schaefer of George Smith Partners. I want to welcome you to my Client Briefing webinar. The views in this webinar are mine, not of my company or any of the partners. I wanted to start off by talking about the difference between purchasing a note and purchasing a property. Most of you are active in commercial real estate, so you understand this difference. The basic thing I wanted to get across is that when you buy a property, you're getting a hard asset. The other thing that people are doing in today's distressed market is they're doing DPOs, where somebody goes to their own lender and gets a discount. And those are easy to finance as well, because with a DPO, you're basically, at the same time you're paying off the note, you're getting the property. A lot of times you're going to finance that to a different lender at that discount, so you don't have to come up with all the cash. But the thing to keep in mind on a DPO or even a deed in lieu of foreclosure is that the transaction is buying the note to instantaneously access the property. What we're really going to talk about today are note purchases where you don't have direct control of the property. So what you're basically going to do is purchase the note with the hope of either collecting the payments or accessing the property. Most people today are buying notes to access the property. The note's either in default or has some issue with it, and they want to buy the note at a large discount and access the property. And that's really what we're going to focus on, is how to finance those transactions. Because for a long time, they really weren't financeable. You had to pay all cash, and it really limited the market to a few buyers. Just to some history or background, last month we completed a transaction, I did actually, that I was sort of proud of because it was a very complex note purchase. We were able to get the client 85% loan to value. It's a confidential transaction, so I can't go into too much detail, but it's a Southern California property. The borrower was in bankruptcy. The lender had given the note buyer 10 days to close, 5 days due diligence, and 5 days closing period. This was a really, really tough transaction, and it became tougher when, the first day, the first lender we had selected all of a sudden backed out of the deal and decided they didn't want to move forward. So with 9 days left, we had to switch to a second lender. Luckily, we had some backup options, and they performed, and we were able to get the deal closed. And as complex as it was, we got all the details done, and it turned out to be a great transaction. So when you think about a note purchase, let's look at a sample. Say you're buying a $10 million note. You're going to buy it for $6 million, and you want to finance it. The options today are, somewhere between 65 to 85%. There's rare cases where you can go higher than that. It really depends on the value of the underlying property and the cost to get there. So if you have a good plan, sometimes you can make this work. As you see, this is the bottom part of the transaction. So after you have that right to access the property, you're going to go find a lender and have them make a loan to you to buy this collateral. And the complicated thing, again, is they're not giving you a loan to buy a property. They're giving you the loan to buy a note on a property. So these are very hard to secure. So if we look at the whole transaction, you're going to buy the note for $6 million. So you now have the note for your $6 million price, but you don't want to put up all the money. So you're going to put up $900,000, and you're going to get a $5.1 million loan. And because this is not a real estate transaction, it makes it a lot more complicated. So what's going to happen is either you're going to do a collateral security agreement or a repurchase agreement with that note lender, because this is a mechanism for them to access the note. Because right now, all they have access to is a piece of paper, and without some type of security, you could go and sell that same note to 5 or 10 or 20 different lenders. So by either doing a collateralized security agreement, which I prefer over a repo agreement, but both of them give the lender some right to take that note at some point in time, usually retain a beneficial interest, but they have the right that if you're doing something wrong or you're not performing properly, they can access that note because that's the only security that they have. And we can go into details. Again, you should always consult an attorney and someone like me that's very experienced with doing these type of transactions. And it basically, as you look at the transaction, it's a very circular transaction where, you are gaining the right to buy the note and only paying $900,000 for a $6 million note, and obviously pulling back a loan that you're going to have to pay interest on. But the key to note is that it's just different than a traditional transaction, and you should be aware of that. And it is more risky, and a lot of attorneys are going to advise you that that note lender is in a very powerful position. So you want to go with somebody that's respected and well known as a lender, because they have to do what they say they're going to do, because they do have certain rights under the agreement, just like you have certain rights under the agreement. And because they're putting in $5.1 million in this particular example, and you're putting in $900,000, they're going to try and protect themselves more than you're protected. So that's something to take into account. So if you want full control of the note, a lot of times you have to pay all cash. By going to a note purchase agreement, and there's different forms in every lender, there's no standards here because there's no law that gives anybody the right to foreclose on a note loan. So they're in new territory, you're in new territory. The industry standards have really been some type of collateral security agreement or some type of repurchase agreement. And I would be careful of repurchase agreements to the extent that we've seen some tax issues and other issues arise because of them. To me, the most important thing is to have a plan on getting in and a plan on getting out. You got to know who the lender is, what they're willing to take, and how you can access that note to purchase it. And at the same time, you have to know just as well what your plan is to get out. Because the last thing you want to do is get in and not have a sure way to get out. And the key thing that any lender is going to look at that's going to give you money to do one of these transactions is how are you going to get out. So, you could be buying a performing or a non-performing note, but you're just buying the note. And you want to make sure that you get the original note and the original deed of trust from the lender. They're going to use an allonge to sign it over to you once you make that purchase. And that'll be done through usually a standard, 10, 15-day escrow. They're usually very quick transactions, and the due diligence period is usually limited. You want to make sure you do have a due diligence period, though, because there are a lot of issues with notes. And I've seen people go out and buy notes sight unseen and think, oh, I'm buying it at a 75% discount. It's a great deal. It doesn't matter. It's not a great deal. There's so many things that can go wrong, and it's such a complicated transaction that it's best to have some due diligence period. And it's even better if you can do some advanced due diligence and make sure you're getting what you think you're getting and find out exactly what the lender's been through. When we look at it, there's really, as far as I'm concerned, there's 5 ways of getting out of one of these notes. You can basically make an agreement with the current holder. You can foreclose on the current holder. You can pay them something to go away and give you the property. You can work some other type of deal where they can stay in the property and pay you some amount of money that works for you and maybe write down their loan amount and restructure their current loan. Or you can find somebody else that you're just going to sell the loan to. So those are really the options. The other option, and it's sort of like restructuring the loan, but if the client or if the original borrower decides that they want to get out of default, usually this isn't likely because they usually owe a lot of money, but that is always an option. If for some reason they are able to go to court and get a court to order that the loan amount is reduced and then pay you off that reduced amount, or if the value of the property has gone up so much, it makes sense for them now to just start making payments to you, that's also an option. And it gets very tricky because I've seen people go in to buy a note post-bankruptcy. So the bankruptcy court has already made a ruling. They've worked out a payment plan for the borrower, and now the borrower is making payments under that payment plan. And I've seen people go in and say, well, they were in default. I think I can foreclose on them and get them out of the property. And we've seen that overall not be the case, that courts have said that if there's an agreement, especially an agreement made by a bankruptcy court, we're going to hold the new lender to that same agreement that the old lender made. So you have to be very careful and know what the stages are and what agreements have been made before you get there, because those can ruin your rights under the note. So you just always have to keep in mind that you're buying this piece of paper that says that the person that signed the piece of paper has to make mortgage payments for you for the property that they have. You're not buying the property. And I'm going to say that over and over as we go through this because it's the most important thing. And you always have to keep in mind that courts can play a big role in this, especially bankruptcy courts. You're going to have 2 trips to courts in most states. You're going to have a trip if the borrower goes into bankruptcy. You're going to have to get a stay from that bankruptcy, and that can be a long process. And the other court you're going to usually have to go to if there's not an agreement, you're going to have to foreclose. And in most states, that requires some type of court appearance and documentation. So as we look at the overall capital stack, always make sure you understand what the as-is value of the property is today. And you have to think of a lot of different factors. There's first whatever you're going to pay for this note, but there's also how much time is it going to take you to get control of the property if that's your goal. What are the legal costs going to be to get there, and what are the capital costs going to be to get there? And so you have to take in all of these factors because you're not just buying the property. I have a little formula that I put together where I basically say the note purchase price minus the market value minus the cost to get there is going to be your profit. So just keep in mind that it's not just what you're paying for the note today. If it's going to take you 5 years and $10 million to get at the property, and it's only a $10 million property, it's not a good buy, even if the note is free. So you have to keep in mind all of those factors. And again, it's the number one thing that people don't think about. And you really need to look at everything from a legal perspective, capital perspective, and a timing perspective. So we're running out of time. If you want to email me or call me, I can go over with you all the key questions that you need to think about when doing a note purchase and financing that note purchase. The key is being with somebody that understands the process and can get it done. Because time is of the essence, and you usually only have one chance to make these deals close. We can do loans from $1 to $100 million. Typical structure is anywhere from 6 months to 3 years. Rates vary a lot depending on if it's a bank or a hard money lender doing the loan. Usually it's around 9 or 10%. In some cases, we can do really low aggressive financing, as low as probably 5.5%. And in some very risky cases, it's going to be as high as 15%. There's also going to be points and other fees that are going to be added. The key is understanding the process. It gets very complicated and there's a lot of risk involved, and it's always safer to buy all cash. But as you know, you can't buy as many deals all cash. We can also help you with a variety of commercial loans. On apartments, everybody's very aggressive today, doing 85% financing and rates as low as 3.25%. Email me or call me for any details. You can also contact my partner, Gilder Rivera. I think where we really add value is we have key relationships with lenders. We're in the market every day. We run the whole process, so you don't have to be concerned about every little detail. We make the lenders compete to get you the best possible pricing. We have access to senior management at most of the lenders. We're not tied to any one product or capital source. We can find the best capital source for your needs. We're really consultants and advisors for you. We do billions of dollars of loans every year, usually between $1 and $5 billion a year. Me personally, I've been in commercial real estate for 25 years, and I've been on every side of the table. I've been an owner, I've been a lender, I've been a developer, and I understand the process. I understand how to get loans done, because that's the key, is getting a loan done. It's just as complicated as selling a building or leasing a property, and if you don't have a professional there helping you, you have a huge risk that your deal's not going to go through. I'm not going to spend a lot of time on this, but from underwriting to marketing, origination, and placement to due diligence and closing, we're there for every step. This just shows you the complexity of the different steps, and again, why it really helps to have someone involved in the process to get it done for you. We can access every conceivable source of capital, and we can place everywhere in the capital stack. So from debt to equity to recapitalizations and mezzanine, joint ventures, restructuring, we have the ability to help you anywhere in the capital stack. Construction lending's been really popular lately as well, and I think there's some great opportunities still to buy notes, but they're going away quickly. So again, I've been doing this for 25 years. You're welcome to read my bio. And thank you so much. We're going to start doing this on a regular weekly basis, so you can always find these videos at youtube.com/GSP Brian. You can always call me at 310-867-2906 or email me at bschaefer@gspartners.com. Again, thank you for your time and attention, and I look forward to talking to you in person.